I'm Sebastian St. James. In a previous video, one of my viewers asked, my question was, should you hedge IVV, which is the S&P 500 versus the hedged version of it, and HNDQ, which is the Nasdaq-100 versus the hedged version of that? To hedge or not to hedge? That is the question. Here is the Australian dollar versus the US dollar over the last 1 month. As you can see, the Australian dollar has dropped 5.82% just in 1 month. Oh, so maybe if you hedged against that, you would have been better off. Here is a chart showing the Australian dollar over 6 months dropping 14.55%. Wow, that's quite a lot. Maybe if you hedged then, you would have protected yourself from that drop. Or would you have made it worse? We'll soon see. When we're talking about hedging, we're talking about currency hedging. So Australian dollar to the US dollar. Oh, I think I've just got an order in. Let's see. Oh, yes, I do. Order number 433 due December 22nd. Just before Christmas. It requires 213 white sponge cakes. Why is a prestigious YouTube finance expert getting orders for cakes? It's because in this video, I have a bakery and my white sponge cakes are legendary. Take a look for yourself. Delicious. So let's have a look at this order. The buyer is redacted. It's redacted because I like to protect the names of my clients. They're completely confidential. Hang on a minute. It looks like my order has a second page to it. Thanks, Sebastian. I'm looking forward to the cakes. Love Ita. By the way, love your channel. I want to make this totally clear right now. The clients of my bakery are completely confidential. I never reveal their names. And I happen to know for a fact that Ita never eats cake. Oh. Hi, Ita. Order number 433 requires the following. Flour, which I get from the US, that's arriving December 15, which gives me enough time to make it by the 22nd. The eggs, I'm sourcing locally. The sugar, I'm sourcing locally also. This is the Yankee Doodle Farm. Their flour is legendary. I always import it. So the flour from the US is going to cost me $179 US. The eggs, well, they're local, $24 Australian. Sugar is $32 Australian. The problem is, my flour is actually paid in US dollars. Now, that could change over time, but my cake is actually a fixed price contract with Ita. There's no wriggle room there. So if the Australian dollar drops by half versus, say, the US dollar, then I'm going to be paying twice as much for my flour and I may make no profit on my cakes. Now, that, for me, is a problem. Here is my solution. I'm going to buy Australian versus US dollar futures. As you can see, December 22, 0.64105. My futures allow me to buy US dollars at an agreed exchange rate in the future. Now, I can actually factor in my costs. And this is great. One of the major uses of currency hedging is for buying commodities such as wheat, oil, jet fuel, etc. This is IVV. It is the S&P 500 ETF. It has a management fee of 0.04%. Here is the IHVV. It is also the S&P 500. However, it's hedged and its management fee is slightly higher at 0.1%. They are both basically the same ETF. They're both from BlackRock and one is hedged to the US dollar. The other is not. It free floats. And that's the only difference. Let's examine IVV a little bit closer and find out actually where these assets it has are stored. What we notice is IVV is actually domiciled in Australia. Interesting. The question is, does IVV hold its assets in Australia or in the US? Well, if we have a look at IVV's holdings, we notice that, it holds the iShares Core S&P 500 ETF financials, which are located in the United States. So the answer is, the assets for IVV are actually located in the USA. IVV is Australian domiciled. It's quoted in Australian dollars. However, we've discovered it's an umbrella shell company which actually holds the American version of the assets. It doesn't hold assets itself directly. When we're dealing with currencies, we're always talking about currency pairs. When you go shopping, you're only dealing with one currency. It's nice and simple, but when you're doing foreign exchange transfers, you're always dealing with a pair. The question is, how the name's written, and does the order in which the name is written actually matter? What do these currency pairs mean? Australian dollar / US dollar, US dollar / Australian dollar. Well, they're just the same. They're just written around the other way. So, what is the difference? Can you figure out the difference? The way currency pairs work when you write them down is the first one has $1 in it and you're transferring into the second currency. So AUD/USD is 0.64 because we're starting with $1 Australian. USD/AUD is 1.56 because we're starting with $1 US. We have discovered that IVV actually holds its assets in the US. The question is, how does holding assets in the US affect me here in Australia when the currency fluctuates? Let's say I own $1,000 worth of IVV. Today, the Australian versus US dollar is $1. Therefore, in Australian dollars, I own $1,000 worth. Although tomorrow, the Australian dollar versus the US dollar drops to 50 cents because the assets are actually stored in US dollars. Therefore, in Australian dollars, it's now worth $2,000. If your assets are stored offshore in the US and the Australian dollar drops, it's actually an advantage for you. I am going to show you two graphs. Then I'm going to ask you a question about them. So pay attention. Here is the 1 year graph of the IVV. What we notice is it goes along fairly well, but yeah, it does drop a bit over time. In the exact same time period, 1 year, we notice the Australian dollar versus the US dollar. Whoa, well that's gone down over time. The question is, if you held the hedged version of the IVV versus the actual straight up version of the IVV, would you have done better or worse under those circumstances? We know the Australian dollar dropped. We know the hedged version is actually pegged to the US dollar. So what would we expect actually to perform better under those circumstances? This is what we know. IVV holds IVV US, which of course is held in US dollars. We know the Australian dollar weakened over that 1 year. Therefore, IVV US is actually worth more in Australian dollars than it was at the start of the year. Right. And because the Australian dollar dropped within the period of time and my assets are held over there in US dollars, then I would expect that the local performance, the IVV, would actually outperform because the currency drop versus the hedged version, which is actually directly pegged to the US dollar. And in fact, that's what we find. In the red and green, we have IVV, which is subject to Australian currency fluctuation. In the black, we have IHVV, and we're tempting there to negate any differences in currency. And we find out, well, they're going along fairly similar. And then, wait, hang on, there's a big difference there. And we find that black, which is IHVV, is well and truly underperformed IVV. Yep, and that's what I predicted, and that's what we got. So, a drop in the Australian dollar is good if you hold your assets overseas. So far, we've discussed IVV versus IHVV, but you know, there is another. There is the US version of IVV. Okay, well, this is interesting. Is IHVV the same as buying IVV US? The answer is yes. In theory, it is, because remember, the hedge version is trying to peg itself to the US dollar. Can you demonstrate this? Well, let's take a look at a graph. Here over the 1 year is the US version, which is in red and green, versus IHVV, which is the Hedged Australian ETF, which is in black. And yeah, they're basically going along fairly well. And yeah, all black slipped underneath there a little bit, but they are rising and falling in sequence there. Okay, good. US version versus the Hedged Australian version. So far, more or less the same. This is the 5 year graph showing exactly the same data. And they're going along quite nicely. And then, oh, just after June, something happens. What is that? And then after that, yeah, they just continue on as if nothing's happened, except you have not made up for that loss. This is interesting because the Australian Hedged ETF should be the same as buying the American ETF directly, but we find it's not. Hedging aims to mitigate the volatility of foreign currency movements and is usually implemented by using derivatives in the form of swaps or forward foreign exchange contracts to lock in exchange rates. Swaps and forward contracts, like when we bought our flour for Ita's cakes. There was another pair of ETFs that F&Q asked about. Let's take a look at them. NDQ versus HNDQ. Here is NDQ. It is the BetaShares Nasdaq-100 ETF. Here is HNDQ. It is the BetaShares Nasdaq-100, just the same as we saw before, except now it is hedged. The astute amongst you would have noticed something slightly odd. It is IVV versus IHVV, and it is NDQ versus HNDQ. Why are those letters actually in a different place? They are two different companies. Apparently, they did not go to the How to Name Your Hedged ETF conference, and so there's no agreement on the name. Pity. IVV is really simple because it's actually held by an American company. So you can buy IVV in Australia or exactly the same stock code overseas. But when it comes to NDQ, that's actually BetaShares, which is an Australian company, and therefore you cannot go over to the US market and buy NDQ. It does not exist. So the commonest options are buying the Qs, triple Q, or QQQM. What's the difference? They're actually owned by the same company. Invesco has them both. They both track the Nasdaq-100, but here it is. The expense ratio, 0.2% for the triple Qs versus 0.15% for the triple QM. That's it. It's expense ratio. There's no other difference. Triple Q is bigger. They've been around for a lot longer. So if you have billions of dollars to buy up the Nasdaq-100, you may actually go for triple Q. However, if you're a smaller investor, then triple QM would make more sense because the fee is cheaper. So here is a magical table I put together that will crystallize everything you need to know. If you're buying the S&P 500 in Australia, you can buy IVV on the Australian Stock Exchange, or you can buy IVV in the US Stock Exchange. The index, by the way, for that, the S&P 500, is the SPX. If you're buying into the Nasdaq-100 on the Australian Stock Exchange, you can buy the NDQ. If you're buying in the US, then you can buy the triple QM. The index there is the NDX. Right. Now I've discovered I can actually buy the US ETFs directly, and I've got the hedged version in Australia. Which should I buy? What is the better option if I want to actually attach myself to the US dollar directly? Here is a triple QM. It is the US ETF versus our hedged version, which is the HNDQ. We'll notice they're going along quite nicely, and yeah, we notice black, which is the local version, the hedge version, is actually underperforming the foreign version. But hang on a minute. Although this is actually supposed to be a 5-year graph, that's what it says, it is definitely not 5 years. What, December 2020? That's just like a couple of years. What is going on there? If we have a look at HNDQ, we find the inception date is actually, the 20th of July 20. The hedged NDQ is actually only 2 years old. So that's all the data we can extract from that. So our conclusion is, the Australian hedge ETFs actually underperform their US equivalents. We've seen that on every single graph. And hedging isn't perfect. If you buy foreign, there are some hurdles that you need to know about. There is a W8 bend form that you have to fill in order to get your tax back. And estate tax, should you cross over to the other side, then your heirs will actually have to do a whole lot of paperwork to make sure they get everything back without paying US tax. Oh, also, when you're doing your tax, then you have to convert everything to Australian dollars. Now it is time for the big showdown. We're going to put everything together in graph form. This is what you've come for. In dark blue, we're holding the Australian version of the IVV. In purple, we're holding the hedged version in Australia. In yellow, we're holding the IVV directly, so that's the US version. Well, they go along quite nicely. And what are we discovering at the end? Oh, there is a difference. Blue has won, gold has come second, and purple, last. Look at that. Here are the results. IVV, the Australian version here, returned 105.16%. So Australia wins for gold. Yahoo! The US version came second, returning 73.29%. And the Australian hedge version only returned 34.35%. That's pathetic. There is a big difference between the hedge version and holding the US version directly. Yeah. If we look at the Nasdaq, which is over a shorter period of time, the NDQ, so the Australian version, is in red and green. Black holds the American version directly. Purple is the Australian hedge version. Purple is actually outperforming there for a while. Quite bunched up there. Oh, it's almost a photo finish. Bring in the scrutineers. Well, we see that red and green is actually outperformed, and the other two, they're basically right on top of each other. So we discover NDQ, the Australian version, returned 1.18%. Triple QM, the US version, returned minus 9.24%. Oh, that's pretty bad. And the hedge version returned exactly the same, minus 9.24%. That's the actual data based on real-world performance. The question is, what does a theory say should happen? Will the Australian dollar versus the US dollar go to 40 cents? And then later on 20 cents, and then 10 cents, and then 5 cents, and keep devaluing over time? No, it will go up and down, but it won't go down forever. I would not imagine in a million years that the Australian dollar would be worth 1 cent against the US dollar. So, with currencies, there is no positive expectation over a long period of time. There's no negative expectation over a longer period of time. All there is fluctuations. In fact, if you look at this graph from the year 2000 up to 2020 and beyond, we notice Australia's actually gone up by 3.08%. Interesting. So, unlike index funds, there's no inbuilt positive nor negative expectation on currency pairs over the long term. Therefore, based on the theory, because their currency, we're not expecting it to go up or down over a longer period of time, right? It's basically a wash. You may as well hold the Australian version, save on the fees, and save on all the hedging risk, which we discovered. But the choice ultimately is yours. FNQ had this idea about hopping in and out of hedged ETFs versus the unhedged ETFs. Let's read. I currently hedge, but at a chosen exchange rate I don't. Interesting. Let's see if we can assess that. So ETF hopping, as I'm now calling it, is a form of market timing. If you believe that you can time the market and you've got a proven track record of it, then you go ahead and you do what works for you. In theory, timing the market should work, right? Because the market's going down, then I jump out, and the market's coming up, then I jump in. In practice, though, for most people, it does not work. So market timing, you do you, but we're going to say it's questionable. The problem with ETF hopping is you crystallize your capital gains. That means it's a taxable event every time you hop. My question to you is, if you can actually time the market and jump in and out of the hedged versions, why aren't you actually timing the market in general? Jumping in and out of, say, IVV versus cash, IVV drops, starting to come back up, jump back into IVV, ride it up. In theory, you can time the market. In practice, probably not so much. That leaves me with one question. If I had $10,000 right now, where would I put it? Click here and find out.